All right, for Module 7, our first part here in Chapter 11, we're going to look at the stockholders' equity in much more detail, where the company issues stock to raise money as a corporation, and then instead of maybe issuing bonds or notes. And then, so we've got to know what kind of stocks there are that the company can issue, and then how do you journalize that? And then what happens if the company buys back their own stock? Because that happens as well. And then one of the latter things we're going to look at is when companies pay dividends, how do they know how much to pay? And then how do we keep track of that as well? So the first thing I wanted to just briefly look at is the two different types of stock that companies can offer. They offer either common stock, which is by default, that is the one that if they only have one, they can only do one, that's okay. That is the one they're going to use. And this is the basic ownership. And you can see, you can read through here what it entails, just real basic. I don't go into a lot of detail, just to give you an overview. And then the preferred stock, this doesn't mean that it's better, it's just the name that's given to it. Preferred stock has some ups, has some good sides to it, and then depending on how it's labeled and how it's issued, there are some downsides to preferred stock as well, so it's not always just the best one. With preferred stocks, you're going to see when we get into some problems, they're listed. There's going to be a percent sign with a number, like 20% of par of whatever the par value is. That percent is going to be how much of dividends the preferred stockholders get, because usually preferred stockholders get a set amount of dividends, and then common stockholders get whatever's left. And so preferred stockholders usually get the first dibs. They get a first set amount, but then a lot of times that's all they get. Common stockholders get to enjoy the rest of it, which could be very little or could be a lot. That's why the common stockholders have the most risk, but also the most reward. Preferred stockholders have less risk because they generally will get a certain amount, but then perhaps they won't get more than that at the end. It all depends on how the stock is labeled, though. One thing to note before we keep going, though, is no, dividends are never required. Companies do not have to issue dividends. So just because preferred stock gets first dibs, that's only when dividends are actually issued. Companies do not have to issue dividends. It's not like when companies issue bonds, they have to pay that interest, whatever's on there, however it's often stated. Or with a note, they have to pay back that note. With stocks, that's not the case. They do not have to pay dividends. And the percentage sign in front of the par simply says, in this case, if it was 20%, $100 par, they would get, for every stock that they own, $20 of dividend if dividends are given. So 20% of 100 is 20. They would get $20 of dividends for one share that they own. Now, when stock is issued, it's going to be in one of these 5 areas where it's going to be landed. So when a company first starts out as a corporation, they're going to set a certain number of authorized stock. That's how many they are allowed to sell. They can't adjust that without doing some major work. That's going to be how much they are allowed to issue. And then once the stock is actually been issued to the public, it stays issued. And once it stays in the public, and once it's continually in the public's hands, it's called outstanding stock. Because a stock can be issued, but then bought back by the company, and that's called treasury stock. It's still listed as issued because it has been issued one time, but it's been bought back, and the company still has it in their hands for the time being. They can resell it at any point, and then it becomes outstanding again. Outstanding simply means it's out in the public hands, and dividends can be paid to it. And then retired stock, if the company decides they're never going to reissue that stock, it'll basically become unauthorized at that point. The number goes down, and that stock will never be issued again. All right, so let's see how stock is, how it's journalized most of the time. When you issue stock, you're typically going to see a par value. Par value, also known as the stated value, those are synonymous terms. The book will try to throw in both terms in some of the problems. Just make sure you use the correct one. It'll say common stock at stated value or common stock at par value. Pick the one that the problem is saying. Both of them, common and preferred, will have par value. And that's simply what you list. So let's, before we do that, let's come over here. When you see, I've got an expanded, and you have a copy of this, and you'll want to open this up. This is for part of the problem that we'll get to in a little while. And I've already got the opening numbers here. But as you can see, I've expanded the owner's equity section of the T account page that we normally use. We now have common stock and preferred stock. And then down below, we're going to talk about these, the additional paid in capital for both. You remember retained earnings, that's still there. And then the other two that we're going to look at is Treasury stock and additional paid in capital for Treasury. Remember, Treasury, that's our contra account, because Treasury is when you repurchase your own stock. So it's going backwards, it's going back into your business instead of being issued the stock. This common stock and preferred, these are the par value. When you, these are always listed at par value. So that's what this is. And then anything else over and beyond the par value that the stock sells for goes down here in additional paid in capital. So we're going to see that now, how that looks, because I know that's kind of confusing right now. All right, so when we look at this example number 1, and we issue 40 shares, and they are designated $5 par common stock, but the stock is currently worth 20 bucks a share. How we're going to journalize that is we're the company giving ownership. So people are paying us to be part owners of our business. And so they're giving us, or we're giving them 40 shares, and they're giving us 20 bucks a share. So when you take 40 times 20, the company is getting $800. And then how we record that stock is we say, okay, in the common stock over here, we would have put 200, because the 200 comes from the number of shares times just the par value. And then whatever's left to make your debits equal your credits, that's what goes into the additional paid in capital. So these two accounts, you can see their numbers are real close. They go together. I just made up these numbers. You could have done 300 and 301 over here, and then 310 and 311. That's fine. I put these two together just to show that they are kind of a pair when you do journal entries. And then the preferred stock looks the same way. Let's say we issue 10 shares of 40% $20 par preferred stock for 50 bucks each. This part is just extra information for right now. This is simply going to tell us how much dividends are paid. It's saying that whatever 40% of 20 is, so if you do the math, that's $8. That's how much dividends each preferred shareholder is going to get, $8. And we got 10 shares, so as long as we give out at least $80, they're going to get the first 80. But how we journalize this, we take the 10 shares and how much they're valued at, and what the investors are paying us. They're paying us the $500, 50 times 10. And then the preferred stock, just like common, is listed at its par value. So 20 times 10 shares, 200. And then the additional paid in capital is whatever's left to get the debits to equal the credits. And then we would have put these over here in their two accounts, the 200 and the 300. Okay, now when a company repurchases their own stock, again, it's called treasury stock, and it's a contra. You're buying back your own company. So what you do is, instead of putting it over here, you would normally, that would probably be your thought process. If I'm buying back stock that I already sold, well, then I would just come over here and debit the common stock. That's not how it's done, and there are reasons why. We'll get into that when we resell the stock in just a minute. But we put it over here into its own T account. So the treasury stock, it's contra. That's why I have it in red. And it's going to have everything over here when we purchase it. And then if I resell the treasury, I'm going to then credit it, just like I'm putting money back into my owner's equity. All right, so treasury stock, it reduces your owner's equity. If you resell your treasury stock, when you resell treasury stock, think of it like selling inventory. Because when you resell your treasury stock, you're going to get rid of the treasury at what you bought it at. Just like when you buy inventory, then you get rid of it with cost of goods sold. You get rid of it, the inventory, at what you purchased, and then the rest of it is your sale price, how much you made on top of that. This is the same. You're going to resell your treasury at whatever you bought it at, and then anything above that is called additional paid-in capital. And I like to think of this as a gain account. Now, it's not a gain, but it's similar to a gain. You can't have a gain in yourself. So if I had bought this stock for $5,000 and then I resold it for $6,000, I don't want to put $6,000 over here because that's going to have me a negative balance. So I'm going to put the $5,000 over here to get rid of the treasury, and then put the extra $1,000 over here that's kind of like a gain. I bought it for $5,000, but I resold it for $6,000. That's pretty good. But if you ever resell it for below the purchase price, what you have to do, it'll say I bought it for $5,000 and I resold it for $4,000. I have to get rid of it at the $5,000 because I don't want to show $4,000 because then it's going to look like I still have $1,000, but I don't. I got rid of it all. So I have to get rid of the entire treasury, and then I have to come over here as a negative and get rid of any gain that I have accumulated. And if I don't have any gain that I've accumulated or I run out, the rest of it is going to go to as a negative to retained earnings. So that's how that's going to work. All right. We're going to take a look at these examples, starting with number 3. Okay, so when we've already purchased that common stock up above, we purchased the 40 shares in example 1. Now we're buying back 15 shares of that common stock, and we're buying it back at $25 a piece. Remember, I had originally sold it for 20 bucks a piece at $5 par. So I'm reselling it, and I'm actually getting a little bit of extra money. We don't count that extra money right away, though. We only count it as a gain. Remember, it's not really a gain. When I buy the treasury, then resell the treasury. When you initially buy treasury stock, you just put it in your treasury stock T account at the price you bought it. Just like if you bought merchandise. You put it in your merchandise as a holding point until you sell it. So I'm putting that treasury stock at 15 times 25. I would put it down here at the 375 as a debit. It's going to increase that treasury, but for any other owner's equity, a debit, what it does is it's a contra, so it reduces your owner's equity. And then if I'm buying back the stock, I had to pay money out to get that, to buy it back. So I had to give my investors $375. Now, I originally, just a second ago, I had said it's like we gain money. I misspoke there. We sold it for 20, but we're buying it back for 25. So we're actually buying it back for more than what they paid for it. They're getting the gain. But we don't count it as a loss, or we don't count it as a gain when we buy it. Either way, we only count it as and again, it's not a gain or loss, but I like to, it helps us to think about it. We're only going to count it as a gain or a loss if we resell the treasury stock, and then we compare it to what we've originally bought it at. Note here, there's no par value. I'm simply just putting that treasury into a temporary holding account. It's at $25, and then when I resell it, then I'm going to get rid of it at 25 as well. So that's what we're doing here in example 4. We bought back 15 shares. I'm going to resell 5 of those 15 now, sometime later. And I'm reselling them for a little bit even more. I'm reselling them for 27. I bought them for 25. So when I resell them, the investors are giving me cash. They're giving me cash for 27 times 5. And then I'm getting rid of the treasury at what I bought it for, the 25. So the 25 times the 5 shares is what I'm getting rid of. So I'm getting rid of $125 of treasury. The rest is that gain that I made. I made $2 a share and I sold 5 shares, so it's 10 bucks. So I would have 10 bucks over here in my additional paid in capital treasury, which is like our gain account. Now, what happens then when I turn around and if I sell the treasury for less than what I bought it for? If I sell it for less than the 25, say I resell it for $21 a share, well, then what happens is I got to say, okay, I'm getting cash from my investors. I'm reselling 8 shares. They're giving me $21 each. So if you do the math, that's $168. Now I'm going to leave this one blank for just a second because I need to come down here and see what I'm going to credit. I'm going to credit my treasury stock for not the 21, but the $25 that I bought it for, just like up here. So 25 times the 8 shares is 200. So I'm going to need to show that, ooh, this time I kind of have a loss. How we calculate that is we would first put in whatever we have in our gain account and then take as much of that as we can up to the amount that we have. If I only have $10 in there from my one transaction, then that's all the more I can take back out. If I had 100, then I could have done, I could have made this as one debit for $32 and still had some gain left over from the previous sales. But I don't have enough. I don't have enough to cover my entire loss. I only have 10. That only takes me to 178 in debits compared to 200 in credit. So the rest of the loss comes out of retained earnings. We don't want to ever do that if we don't have to. We don't like to ever debit retained earnings because that's taking away part of the investment in the business. But in this case, since we resold the treasury for less than what it was worth and less than any gains that I had left, that's what we had to do.